As of 11:50 a.m. Eastern Time, Wolfspeed Inc., trading under the ticker WOLF, is experiencing a truly astonishing session, priced at $17.60. That's a staggering intraday surge of over 1,300%. Now, before anyone rushes to their trading app, whether it's on Robinhood or Fidelity, believing they've stumbled upon the next semiconductor titan set for a meteoric rise, we need to address what is actually happening here. This isn't a move based on a groundbreaking new product or a multi-billion-dollar contract. The reality is far more complex and tied to the raw, unforgiving mechanics of corporate restructuring. This stock is emerging from the depths of Chapter 11 bankruptcy, and the extreme volatility you're witnessing is not the sign of a healthy, thriving enterprise, but rather the speculative frenzy that often accompanies a company attempting to relight its furnaces after a near-total collapse. The common belief, the narrative that has kept Wolfspeed on the radar of many investors using platforms from SoFi Invest to Interactive Brokers, is centered on a compelling and undeniably important technology, silicon carbide. The expectation has always been that Wolfspeed, as a pioneer in silicon carbide and gallium nitride, or GaN semiconductors, is perfectly positioned to ride the enormous wave of electric vehicle adoption, 5G network build-outs, and the renewable energy boom. These wide bandgap semiconductors are superior to traditional silicon in almost every way for high-power applications. They are more efficient, they can handle higher voltages, and they can operate at higher temperatures. In an EV, this means longer range and faster charging. In a 5G base station, it means more power and less signal loss. This is the story, the grand expectation that led many to pour capital into an individual brokerage account and buy shares of WOLF, believing they were getting in on the ground floor of a fundamental technological shift, much like the early days of Nvidia stock or even Apple stock. But here is where that expectation has violently collided with a brutal reality. For all its technological promise, Wolfspeed has been a machine for burning cash. A look at the company's financials over the past few years paints a grim picture of widening losses and negative gross margins. The cost of building out the capacity to meet the anticipated demand, particularly the massive John Paul Moore Manufacturing Center for silicon carbide in North Carolina, has been immense. The company took on substantial debt to fund this expansion, betting that the revenue would arrive in time to service those obligations. It did not. The reality is that building out cutting-edge semiconductor fabrication facilities is one of the most capital-intensive undertakings in any industry. Delays, cost overruns, and a competitive landscape that includes behemoths like ST Microelectronics and Infineon Technologies created a perfect storm. While investors were dreaming of EV domination, the company was grappling with a balance sheet that was buckling under the weight of its own ambitions. This led to the inevitable, a Chapter 11 filing to protect itself from creditors and attempt to reorganize its finances. So what does this recent eye-popping stock movement signify? It's tied to the confirmation of their reorganization plan and the company's plan to officially emerge from bankruptcy protection. Typically, in such a restructuring, the old equity is canceled and new shares are issued. The massive price swing is less about fundamentals and more about the market trying to price these new post-bankruptcy shares. It's a highly speculative environment, driven by traders and funds that specialize in distressed assets, not necessarily long-term investors looking for the next stable growth story. Many retail investors, perhaps using the streamlined interface of the Robinhood app or setting up their first self-investing account, might see a price chart that looks like a rocket launch and jump in unaware of the immense risks. The trading volume is enormous, but it's chaotic. Institutional investors are likely rebalancing, some are exiting, and new high-risk players are entering. It's a classic case of expectation the company is saved, clashing with the reality that the path forward is still fraught with peril. A new corporate structure and a cleaner balance sheet are necessary first steps, but they do not guarantee future profitability. The operational challenges that led to the bankruptcy in the first place still need to be solved. Let's briefly touch upon the core business because the technology itself remains impressive. Wolfspeed operates in two main areas, materials and power devices. They produce the silicon carbide wafers that are the foundational material for these advanced chips. They are one of the few vertically integrated players in this space, giving them a theoretical advantage in controlling their supply and quality. Then they use these materials to manufacture power modules and other devices that go into inverters for electric vehicles, charging infrastructure, and industrial power supplies. Their customer list includes major automotive manufacturers and industrial giants who are all desperate to secure a stable supply of high-performance silicon carbide components. This is the core bull case, and it's why, despite the financial turmoil, there's still a flicker of hope. The demand is real, and it's growing at an incredible pace. The question has never been about the market, but about Wolfspeed's ability to execute and become profitable. How many shares of Wolfspeed do you currently hold? Comment below and let me know if you're holding through this restructuring. Looking ahead, the future of Wolfspeed is a tale of two potential paths. The optimistic scenario is that the bankruptcy process has successfully purged the company of its unsustainable debt load. With a fresh start, and with their new 200mm wafer fabrication facility, the world's largest, finally ramping up production, they can start to meet the massive backlog of demand and generate positive cash flow. If they can execute on their manufacturing goals, control costs, and maintain their technological edge, the company could still grow into the valuation that investors once dreamed of. Financial advisors managing accounts through services like Schwab Intelligent Portfolios or Fidelity Wealth Management might start to see it as a viable, albeit high-risk component of a growth-oriented portfolio. The company's recent announcement of the commercial launch of its 200mm silicon carbide materials portfolio is a step in this direction, signaling that the operational engine is starting to turn. However, the pessimistic scenario is just as plausible. Emerging from bankruptcy is not a magic wand. Competition has not been standing still. Other major semiconductor firms are pouring billions into their own silicon carbide capacity. Wolfspeed may have lost valuable time and market share during its financial struggles. Furthermore, the risk of equity dilution is significant. The reorganization plan likely involves issuing a large number of new shares, which could suppress the price for a long time. The company will have to prove that it can not only manufacture at scale, but do so profitably, something it has struggled with historically. Any operational hiccups, delays in ramping up the new fab, or aggressive pricing from competitors could quickly put renewed pressure on the company's finances. Investors looking for investment help or exploring various investing sites need to understand that this is not a stock for the faint of heart. This is a turnaround play in its rawest form, and many such attempts fail. The intelligent portfolio of a cautious investor would likely steer clear until a clear trend of positive earnings is established. In summary, the dramatic surge in Wolfspeed stock is a textbook example of the market's reaction to a corporate rebirth, but it's crucial to separate the speculative frenzy from the underlying business reality. The expectation has always been that Wolfspeed's superior technology would make it a dominant force in the high-power semiconductor space. The reality was a company that expanded too quickly and was crushed by the weight of its own debt, leading to a necessary but painful bankruptcy. Now, emerging from that process, the hope is rekindled. The balance sheet is cleaner, and the path to production is clearer. But the fundamental challenge remains the same: execution. The company must now prove that it can not only manufacture at scale, but do so profitably, something it has struggled with historically.